Before we head into this week's market outlook, understanding repos is up. For those of you who have the applied level, it's in sector studies in the financials sector. There's a separate folder for it. Understanding reserves will be up Monday, will be up tomorrow. Here's a screenshot from it, from some of the screenshots that I put up. It's important, I think, to watch it before the Fed press conference because questions will be asked about the reverse repo and about the quantitative tightening program in place now. I'm sure questions will be asked. And to understand the answers when they start talking about the level of reserves, you'll want to understand what reserves are and what ample reserves are as opposed to scarce reserves. Okay, let's begin. Not a lot of excitement in yields and rates last week. Money market, all well behaved. In fact, from the 1 to the 3, almost nothing going on. And if we don't expect the Fed to do anything, we shouldn't expect anything to happen there. And then the capital market yields just nudging around a bit. But we got two big risk events for yields next week, or for the capital market curve. You have the Fed and what they're going to say about the pace of balance sheet runoff and what they're going to say about when they're anticipating rate cuts. I'm sure those will be two big questions. You also have Treasury refunding happening next week, an announcement of what they plan to issue, or the sums that they plan to issue. Curve inversion, or I should say curve uninversion, continues in the capital market. Just the 2 to the 10 of the ones I have, just the 2 to the 10 remains inverted. In Canada, it's negative 53. The money market to capital market inversion still well over 100 basis points at 129. Canada's at 150, and again, look at those days. Balance sheet runoff continues. QT out of the SOMA, another $4.5 billion, down to 7. Just a little over 7 trillion here, 41 billion. So before the end of February, we will be printing a 6 handle on this one. The Fed balance sheet in total is up 3.489 billion, considering you had runoff here. Anything outside of securities holdings have increased 8.06 billion. Money market funds still decreased. Second week in a row. I don't think I've seen 2 weeks in a row yet for quite some time, so that's interesting. And the same pattern as last week. Retail continues to add, up 5 billion in government and prime, with money coming out of the tax-exempt money market funds, and for institutions down 6.5 billion. All government, 9 billion here. Prime up 3.47. FOMC, 3 days away now. Wednesday afternoon, press conference is everything. 2 o'clock, you'll hear no move, and the market will react wildly and then calm down and say, no, hang on. It's the press conference that matters. Also in the morning at 8:30 for Canada, we get GDP. I say we. It's going to take me a while to break the we. Canada gets GDP monthly. So December, which is the preliminary look at December, happens in 3 days. Big week for jobs this week. Tuesday, the JOLTS report. Wednesday, ADP and ECI. This is for the fourth quarter of 2023, the Employment Cost Index, which is the true measure of wage inflation. The very next day, we're going to get non-farm productivity and unit labor cost, given that GDP was 3.3%. And if you look at the jobs report, we get that on Friday, non-farm payrolls for December, unless that number came in really, really huge. If you look at the jobs report, sub 200,000 or in around the 190 to 200,000, that's just not enough growth to account for 3.3%. So there had to be something for productivity to get growth at 3.3%. When you look at the third quarter, fantastic growth, but fantastic productivity, and you had negative, below zero, you had negative unit labor costs. That is deflationary, period. There's no argument about that. That is deflationary. To have 3.3%, given that the jobs market we had doesn't seem to justify going from a trend growth of 1.8% all the way up to 3.3%, which means productivity had to do some of the heavy lifting. And if you have a big print on productivity, you have another negative read on unit labor costs. That is deflationary. And with the PCE read we had last week, it kind of looks like that's the background story. So we've got big jobs information this week, followed by the FOMC, and just in case you think that's not enough, Tuesday we have Treasury refunding announcement, which is huge risk for the capital market curve for yields in capital markets. Get that at 8:30. And in case that's just not enough for you, layer on about 90 companies reporting this week and some big tech companies reporting this week, and there's always volatility around that. This is a big week. However, there are no capital market expectations, so you can breathe a sigh of relief there. It's like, whew, I can handle everything else, but please no auctions. 97% on zero, 2.6 on negative 25. I don't think that that we can read anything into that. That's just positioning and hedging that would create what looks like a probability but isn't. Let's just call it 100% for zero. No one's expecting anything, certainly not a rate hike. And I think if they do a rate cut, their credibility is gone. So it's a zero. I don't think anybody anywhere thinks anything is going to happen. It's all going to happen in the press conference. The reverse repo is going to be a question because it really came down. We can see over here we're printing new lows for this cycle, at least on the reverse repo. So QT is going to be a question. When do they anticipate that they're going to start to taper, or is it a part of the conversation now? And probably pushing on, have we not seen enough evidence on inflation? When will be the first rate cut? Do you think it's Q3 or could it be before Q2? There'll be something on that. As far as the probabilities in the market go, it didn't really change that much. 3 cuts by June, 36% probability, up from 28.5. And no more than 2 cuts, either 0, 1, or 2 cuts, was 68%, now down to 63. But having more than 3 cuts by June is almost non-existent now. Reverse repo dropped 54 billion, 570 billion. There was a new low on the 25th on January of 557 billion. The bank term funding program increased 6.26 billion from 161 to 167. And if you are subscribed to the central bank for their press releases, you got your notice last week that the Fed is ending this program March 11th, period, end of story. Lag in the system, still 100 basis points if we accept a 12-month lag. Next week, at least from a year ago, a central bank meeting would have happened, so we should end up somewhere down at 75 basis points as of next week. Let's have a look at that press release. Okay, to find this one, just go to news and events, click on press releases, and you'll get them all. And it's from January 24th. There it is here. Federal Reserve on Wednesday announced the bank term funding program will cease making new loans as scheduled March 11th. Program will continue to make loans until that time and is available as an additional source of liquidity for eligible institutions. We could skip the middle paragraph here. As the program ends, the interest rate applicable to new loans has been adjusted such that the rate on new loans extended from now through program expiration will be no lower than the interest rate on reserve balances in effect on the day the loan is made. This rate adjustment ensures the bank term funding program continues to support the goals of the program in the current interest rate environment. The change is effective immediately. All of the terms of the program are unchanged. That was it. So this just shows up on their site. And then some news feeds will pick it up and they'll talk about it, and maybe that's how you heard about it. But if you are subscribed to the news feed for the Fed, you would have got this email to you Wednesday night, and you would have known. There we are. It will end March 11th. So I don't anticipate any questions on this one at the press conference unless somebody has some specific question about why did you choose to end it? Are you seeing that it's not being used? There is a balance that's increasing every week. Maybe there'll be some question about what are you seeing that that seems to be different than an increasing balance in the program each week. No excitement in real yields either. Very small moves. The curve is still upward sloping, and inflation expectations, or more rightly called break-even rates, have pulled back a little bit. Also matching the nothing interesting to see here story is the Fed funds futures. Almost no change week over week. No change over here. I think here you had a move of minus 1.5 basis points. Here you had a move of half a basis point, and week over week here another half a basis point, to the extent of saying, well, there's nothing to see here. Still 5 rate cuts being priced in. Looks like 2 in Q2, and Bostic says they're not starting until Q3, so this may be premature. But that is going to be a question in the Fed that the market seems to be at odds with you guys, and the market has anticipated your moves fairly accurately over the last year. Are you behind the curve? And have you not seen enough evidence? What more do you need to see? We've had negative unit costs for 2 quarters, because I do anticipate the unit costs we'll see this week will come in negative. And all measures of inflation except the year over year appear to be at or below your target. What are you waiting for? TLT, very low move here, down 0.33. Nothing to see here again. SPY hitting new highs, 1.17. Hit a new all-time high on Thursday and just gave back like less than a quarter, like 25 cents or 30 cents on Friday, but printed a new all-time high on Thursday, sitting just below that. Implied volatility on TLT for the last 13 weeks pretty much disappearing. We look at the put call outstanding interest, 0.52. In other words, 2 calls for every put. That would be on the offer, 2 calls for every put. So there isn't a lot of put buying. There doesn't seem to be a lot of fear on put buying, so this kind of supports some put selling. So if you go out to February 16th, the 92 put, which has got roughly about 25 delta here, 61 cents. If you want to go to a 40 delta, 93 put at 95 cents, and it seems to have held the 93 territory quite well. I don't anticipate that the Fed is going to shock to the hawkish side. I don't anticipate that at all. The data doesn't support it. The Treasury general account has moved up. It's over, I think, 800 billion now, 800 and some odd billion, and Yellen is targeting 750 billion. So maybe the refunding will be less than what is anticipated. If it is, that 92 and 93 is going to hold very well. Your big risk on this, I don't think the Fed is a risk on selling puts. I really don't think the Fed's the risk here. I think the risk is the Treasury refunding, which is Tuesday at 8:30. So if you wanted to wait till the refunding announcement comes out and then think, well, okay, if I want to grab some extra premium here, selling puts on TLT, to me seems low risk. If we think the Fed is going to guide the activity past that, I don't see the Fed turning hawkish. Mortgage rates gave back 9 basis points, 6.69 on a 30-year. The Treasury didn't move Thursday over Thursday, so the spread increased by the full amount, 255. Mortgage REITs did fairly well, agency and Annaly, and ABR, no respect. Unfortunately, this is just the case with ABR. Of the years that I've been with this little guy, it never gets the benefit of the doubt. Never. It has to sing for its supper every single quarter. It has to fight and earn respect. It's never just granted respect. And I see other stocks that get so much respect on revenues that are 10 years in the future, and this guy keeps performing. keeps performing, and no respect. The short attacks continue. The regular slate of ambulance chasing law firms circle. Oh, if you've lost money, give us a call. We're looking for a lead plaintiff. They're always looking for a lead plaintiff. So I think you're not going to get anything out of this until they actually report earnings. DHI down 10%. In sympathy with some of the other housing stocks, except this crazy volatile guy at the bottom here. The guidance from DHI was fairly decent, but margins for the quarter did slip because of the incentives they're providing. Has housing run its course? Is this sort of an early warning? To answer that, we have to just look at the stock of housing available and the population growth, with immigration rates rising in the U.S. I think they're at or above pre-pandemic levels. Now that's just counting legal immigration. That's just counting legal. America has a huge problem with illegal immigration, and contrary to what some Republicans are saying, it's not the Canadian border. It's not the Canadian border. Although I can see if there are people flooding into the U.S. from the Canadian border, let me tell you something. They're coming in with money because they got to get away from that government. The problem is the southern border, and that number is, some estimates are putting it at 3 to 4 million, on top of the million that's coming in legally. Well, where are they going to live? I mean, they're going to go somewhere, which will mean that somebody else can't live where they're going, so they're going to have to go somewhere. So, somebody other than buying a tent manufacturer for tent cities, the story for housing, I think, is in place for the next 5-6 years, easily. So, I'm not too concerned about what's happening when mortgage rates are 6.7%. I don't know if I'm going to continue to follow the REIT sector. IYR, I think, has become a little bit boring. PLD is the largest in logistics, down 1.22. DLR is the largest in data centers, up 4.19. They're sort of, leading indicators for their sectors, but I don't know that I've been paying too much attention to them. And then your house builder and housing construction indexes here. While if these are down, these are down. Look at OAS. Look at high investment grade 0.98. 0.98. That is now below the CDS fixed rate. So you are switching in a market from CDS buyers having to pay an upfront fee to the seller now having to pay an upfront fee to the buyer of a CDS for credit protection, because the rate is now below the fixed rate of the CDS. It's been that way on high yield for some time, but now it's on IG. Mortgage apps up 3.7%. Building permits up 1.8%. That was the final look for December. New home sales month over month up 8%. 8%. And pending home sales month over month again up 8.3%. Tuesday we get the housing price index for November and Case-Shiller. Remember, this is at an all-time high. All-time high. Rates went from 0 up to 5%, and housing prices kept hitting new highs all the way through. Unbelievable. You're gonna have to rewrite some sections of a textbook to account for some of these things. Okay, fourth quarter, real GDP, 3.3%. And as I said earlier, this week we get productivity and unit labor costs out of Q4. And I expect productivity to be high and unit labor costs to be negative because, as I said, the growth in the job market doesn't support 3.3%. Let's see how it breaks down, this 3.3. These numbers here are contribution to the 3.3. The numbers at the bottom are individual growth rates for each of the components. So the consumer, 1.91 of the 3.3. And if we look at the consumer growth, quarter over quarter, consumption grew 2.8%. So if it contributed 1.91, 1.91 divided by 2.8 will give you the percentage contribution of consumption to real GDP. Added 1.91, goods 0.85, services 1.06, and in goods both durable and non-durable, all of it positive. Investment, which is one of the more volatile components of GDP, 0.38. Fixed investments, 0.31, both residential and non-residential, and the most volatile, or the most, probably one of the, I wouldn't say most volatile, one of the most difficult to predict is inventory. Almost nothing happening there, 0.07. For government, 0.56, Fed and local, both contributing, and for the Fed, both defense and non-defense, both contributing. And for the trade balance, it helped, 0.43, exports 0.68, imports took away a little here, and both goods and services equal. And for imports, goods and services, well, you have to add up to negative 0.25, so they'll both be negative there. Core PCE quarter over quarter, look at that number. That is the quarter, that's for the quarter. PCE, not core, but headline, PCE, 1.7. You are below the 2%. So no matter if you look at headline for the quarter or core for the quarter, the Fed is where it needs to be. It just needs to see that for a while longer. We're looking at growth rates quarter over quarter, 2.8% increase in volumes, because this is real GDP, 2.8% increase in volumes, both in goods, 3.8%, 2.4% for services, and in goods, 4.6 on durables, 3.4 on non-durables. This is interesting in itself because usually at elevated interest rates, non-durables don't really show those kind of numbers. Investment grew 2.1% quarter over quarter, and government spending 3.3%. Overall, it's a strong report. Now, I used to make the case that it's going to be hard to get growth without getting inflation, unless you get huge productivity. If you get productivity, you can have growth with what would otherwise look like inflation. So you can have an ECI, an employment cost index, come in at 6%, which would look to be inflationary. But if productivity comes in higher than 6%, then it's not. It's actually deflationary. The productivity component outweighs the price component and actually turns unit labor costs negative. So if you're paying somebody 5% more, but they're producing 6% more output, your unit labor costs turn negative. So your margins increase, or in a competitive marketplace, your selling price can decrease without affecting your margins. So 3.3% is a big number. I do expect that our unit labor costs will be negative, and again, that is deflationary. Okay, let's look at PCE and a section from one of the tables which has the change from the preceding period from May all the way to December. We have 0.2 on headline personal consumption expenditure, 0.2. Goods, negative 0.2. Durable, negative 0.4. Non-durable, negative 0.1. Services are 0.3. If we look at core PCE, 0.2. Food was only 0.1. Energy, goods and services, a little hot at 0.3. But look at you coming off two October, November, 2 big months. Nothing ever goes straight down. It tends to do this. So still think you have a step down going on here. Market-based PCE, 0.1. That's headline market-based PCE. If we look at market-based core, 0.1, you are well below the Fed target here. So everything seems to be at or below, unless you look at a year over year. And when we look at year over year for PCE, percentage change from a month ago for December, you're 2.6. August, 3.3, down to 2.6 by the end of the year. And core was 3.7 down to 2.9 by the end of the year. This is lower. This 2.9% is lower than April 2021. It's a 33-month low. It is surprising how quickly it is coming down. But given those big GDP prints, you do have in the background deflation going on. Technology is productivity enhancing, which is deflationary. Technology is always deflationary. I think the Fed may be surprised at the speed of this, and it would surprise me if a question wasn't asked to the Fed. Are you, given the speed of the decline is exceeding what you have in the summary of economic projections, do you see yourself moving up your rate cuts to the second quarter? I think that's at least a question I would ask. Okay, market continues to get more expensive based on a multiple, not just the price that you pay. Closing SPX was 48.97, but we're now at 20.28 times, up from 20.01. A combination of higher closing price and lower operating earnings. Not much, not falling off a cliff, but as I've said before, it's just going the wrong way. You'd like to see it going up. 242.21 down from 242.92, and 240.08 down from 240.68. So the combination of those two things makes the market more expensive. I think the only market more expensive than the U.S. market right now on a forward basis is India. But India has a good fundamental growth story, I think, that is in place for quite some time. I do see India as being what, take the last 20 years and what China was, flip it forward the next 20 years, and I think that's what India will be. So I think that their forward multiple is justified by their higher growth rate. Now you could say, well, look at the growth rate in the U.S. 4.9 in the third quarter, 3.3 in the fourth quarter, and if technology is really going to accelerate, and if it is deflationary, could you not end up with a much higher growth rate without inflation in the U.S. and have this multiple justified as well? I don't think our growth rate is going to be near what India's growth rate will be. It will have China-like growth rates, I think, for the probably next 6-7 years at least. So I think that is a nice long-term play, and I think Mexico is in there as well. I don't see those trends as being disrupted, even with lower interest rates globally. I don't see those trends being disrupted, probably accelerated. They're sort of still my best bets. There are cheaper markets than the U.S. market. Japan is still a cheaper market. The UK is a cheaper market. Europe's a cheaper market, although their PMIs look absolutely terrible. I think they're all in contraction, both on goods and services. But if we're looking for, buy low, sell high, it's not the U.S. The U.S. right now is buy high and, hope you can sell even higher. Or if earnings do accelerate faster than the price grows, you could buy high and sell low at a higher price. Low by meaning that you could have the multiple move down to 20 to 19.5 if your earnings growth is faster than your price growth. I don't know if the American market, the American investment community would even sit back and not bid up the price if earnings were growing. I think this would probably push closer to 22, 23. Anyways, I don't know that there is anything really on the horizon that kind of threatens that. If you getting growth from productivity and not just from massive government spending, if the consumer is still alive, and here's the deal with the consumer: if you give them a paycheck, they're alive, period. If you give them a paycheck, they're alive, and you still are creating jobs. You still have multi-decade lows on unemployment, so the consumer is still in the game. I don't know that there's anything that I can see that could derail this, but external events are external events. They are, by their very nature, non-predictable, and you have a brewing well, I say brewing crisis in the Middle East. I think you've always had a brewing crisis in the Middle East, but tensions, I think, are higher now than I've seen in quite some time. Implied volatility disappearing as well. Market did an all-time high, 486.94 on January 25th, gave back just a little bit. What are we talking about here? 19 cents. Gave back 19 cents on Friday. But, you know, if you have a shorter term chart, this is a 1-year chart, so it's hard to see. But at the very end, you're seeing these long wicks. When you see candles with these long wicks, things like this, that is usually a reversal indicator. What it's saying is that it tried to go up, but sold off during the day. Tried again, sold off during the day. Tried again, sold off during the day. Those long wicks at tops are bearish indicators, so watch out. See here, you had a couple of long wicks, and then you had a small pullback before you had the next run up. But usually when you see a collection of long wicks like that, also it could just be you have it over here, you see a bunch of long wicks before you start coming down. It also could be hesitation in front of the Treasury refunding announcement and in front of the Fed. And with earnings have been mixed. Earnings have been mixed and asymmetrical. When companies are rewarded, they tend to go up by less than when they're punished. And it's been mixed. It's sort of been, you know, half and half, that some reports are coming out and no, down they go. So Netflix was rewarded very nicely. Tesla was punished very badly. Rightly so, given that press conference, or given the earnings call. I don't know if you listened to the earnings call, but there were points where they were the management were debating issues. You know, this is this. Well, it's not really that, is it? Yeah, you're right. It could be something else. Well, I think it's this. It's like, guys, you've got an earnings call going on here. Is this a conversation you can't have offline? You got to have it in front of all the investors. You're disagreeing on a point. So you got to listen to it. If you haven't listened to it, you know, I'm sure you've listened to earnings calls before. I'm sure you have. You have to listen to it. And if you want to experience new levels of sheer absolute boredom, listen to the AT&T conference call. They just don't know how to have a conference call. They don't know how to build excitement. One thing I'll say is Musk knows how to build excitement. So he gets points over there that the team from AT&T might want to do themselves a favor and watch a T-Mobile conference call or listen to this one. But my God, like, just show some excitement, even in your voice when you're talking about the things that you're doing. You know, you're reading it off a chart and you're reading it in a monotone tone. It's like, come on, have some excitement about your business. Get me excited. But God, I had to stop. I couldn't even listen to the whole thing. It was so boring. But if you're having trouble sleeping, put your earbuds in and start the earnings call for AT&T, and you will be asleep in no time. But if you want to have a good laugh, listen to the Tesla conference call. Going into next week, we have earnings, but I can't figure out how many companies are reporting. S&P Global says 71, LESG says 86, Sector Spider says 91, Earnings Whisper says, I think it was 81. It's all over the place. So I don't know where to look. I don't know what's real. I don't know what's true. And I did not feel like verifying all of these. I didn't feel like checking each one of these with the company website to see when earnings. That would have taken hours and hours. I didn't feel like doing it, so I thought, you know what? Have a look at all of them. And if you see a company repeating on all three, well, you could be fairly certain it has earnings that week. But none of them are the same. I don't know what the problem is. They used to be extremely reliable. Every time, every earnings season, you'd have one calendar, and it was extremely reliable. But the last 2 quarters, they've just gone off the rails and said, you know, let me just throw some numbers at this. Like, everyone's just got bored of their job and what they're doing. So it's either time for promotion to something more exciting, or a sit down and a discussion about the meaning that you're deriving from your job, because how can you be off by this much? Look at that. They're not even close, 71 to 86 to 97. It's like, I don't know. Here, well, does this work for you? Anyways, we're all on our own when it comes to earnings this week. But big tech is reporting this week. So you're going to see, I think there's Amazon, Google, Apple, a couple other big ones reporting. It is their week, along with Treasury refunding, along with a whole bunch of jobs report, along with the Fed. So not a lot happening next week. And that'll do it. Just a quick reminder again, the understanding reserves will be up before Wednesday, because we do have to, if you're going to listen to the Fed press conference, I think it will be very helpful if you clearly understand what it means to be in an ample reserves regime, because questions will be asked about the RRP and will be asked about the pace of QT. And understanding what the ample reserves regime is and where the level of ample reserves are will be helpful. And that's it.